Hi, everyone, and welcome to Types of Investments with the Pennsylvania Department of Banking and Securities. I'm Maria Burchell. I'm Head of Adult Services for SCLO Library, and I'd like to welcome you to the event tonight. We are very lucky to have Katrina Boyer with us to take us through this slide deck. Katrina.
Thank you so much. This is Katrina Boyer. I'm the Investor Education Coordinator at the Pennsylvania Department of Banking and Securities, and I'm so glad to be here presenting with the SCLO Library about different types of investment accounts. And as we get started, we're going to talk about two different types of investment accounts. We'll talk predominantly about retirement accounts and wealth building accounts. There are other custodial accounts. There are educational accounts, lots of other types of accounts. Today, we're focusing on those two types. So I want to start with IRAs, or individual retirement accounts. Now, we hear a lot about IRAs, and we kind of all have a general understanding. What I like about Roth with a traditional IRA is that you may be able to choose the types of investments. Your deposits could be tax deductible. It depends upon your financial situation, and you want to make sure that you check with your investment professional or your financial professional, your tax preparer, to make sure of that. Maximum deposits for 2023 are $6,500 unless you're over 50. If you're over 50, you get an extra $1,000 to deposit. Now, what that means is that you can deposit up to $6,500 in 2023 from your income. Now, your income in a traditional IRA goes in before it's taxed, so you're not paying tax on it then. The earnings grow in that account until you're 62 years old, or 62 and a half, whatever the age is to withdraw that money. It grows tax deferred. Now, what you have to keep in mind with that is that at the end, when you start to pull out that money, you are going to be paying tax on that money that you withdraw. Now, the thought process is on that you are going to be in a different tax bracket. So your tax, the amount that you have to pay every year, the percentage in your taxes would be lower, so that you're going to not have to pay as much tax. Now, the opposite of the traditional IRA is the Roth IRA. Again, you can choose the type of investment accounts, but deposits that go into your Roth IRA are deposits that are made after you've already paid tax. The maximum deposit is the same as the traditional. So remember, that's at $6,500 plus $1,000 if you're over 50. Withdrawals and your earnings grow tax-free. Now, if you find yourself in a position where you need to make an early withdrawal of your contributions, you can do that without paying a penalty. With the traditional IRA, you are going to be looking at a penalty plus the taxes for early withdrawal. Now, anything that you would withdraw from your earnings on a Roth IRA, you may have to pay a penalty on because you're not 62 years old and old enough to retire. Now, there are a few other types of IRAs that I want to go into because I think it's important that we recognize that there are other types of individual needs. So an IRA requires that the individual making the deposit is employed. It's an individual retirement account. You have to make those deposits from money that you've earned. But what if you're a spouse and you choose to stay at home and take care of the household? Well, there's an IRA for spouses as well. It's for married couples where one spouse doesn't work, but the other does. It allows the spouse who's not working to be able to put some retirement money away as if they did earn. And the benefits for that are, again, identical, the $6,500 and the $1,000 if you're over 50. It allows you to have that that retirement plan for yourself as well as your spouse. It's a great way for individuals who are making those decisions to stay home to be able to still plan for their long-term retirement goals. And then there are two other IRAs that I want to talk about. The first one is called an employer-sponsored IRA, and it stands, there's the SIMPLE, which stands for Savings Incentive Match Plan for Employees. And basically, an employer is able to make contributions up to 3% if the employee is putting money in also. So if the employee puts in 3%, the employer can put in 3%. If the employee is not depositing into the SIMPLE IRA, then the employer can do 2%. Now, the contribution maximums are higher for this. So for 2023, that contribution maximum you can see here is $15,000 plus $3,500 if you're going to be doing a catch-up. And excuse me, that maximum contribution is $15,500. Now, what's nice about this is your employer, if they're doing this type of employer-sponsored IRA for you, the employer can take a tax deduction based upon their contribution. So that's something that's beneficial for the employer. Another type of IRA that I want to talk about is the SEP IRA, which is the Simplified Employee Pension. It's for small business owners and their employees. The employer makes all of the contributions, and those again are tax deductible to the business. And I have to check. I apologize. I think I missed updating the limits for 2023 on this slide, but in 2021, it was 25% of the employee's tax, the employee's compensation, or $66,000. Now, the caveat to this one is that the employer has to contribute the same percentage to all of his employees or her employees as they do themselves. So they can't take 100% of their salary and put it into an IRA and then only put an employee's salary of, like, they maybe only would want to do 5 or 10%. So the IRS recognizes and says that if an employer is going to do this, they have to do the same amount across the board for all employees, including themselves. And then the last form of IRA that I want to talk about today is a payroll deduction IRA, and that's for small business owners who maybe don't have the ability to offer some of the other types of IRAs, or maybe they don't have some other form of retirement, but it offers a low-cost opportunity that doesn't have a bunch of other additional requirements. Employees make all of the contributions, but the employer is sort of the middleman and helps to make sure that the payroll deductions come out as they're supposed to. Excuse me, with the payroll deduction IRA, it is the same, the contribution limits are the same as the traditional or Roth IRA that we talked about. $6,500 if you are under 50, and that extra 1,000 or 7,500 total if you're over 50 for those IRAs, those individual retirement accounts. Now, like I said earlier, with IRAs, you can typically choose how your investments are going to be invested through those accounts. Now, the next type of investment accounts, retirement accounts that I want to talk about are 401ks. A 401k is what we often hear when we talk about employer-sponsored retirement plans. It's for employees who work for a traditional for-profit company. Your earnings are typically pre-tax, the earnings grow tax deferred. In 2023, the maximum contribution for 401ks is $22,500 or 100% of your income, whichever is less. And then if you're over 50, there's an extra zero there I just recognized. If you're over 50, you can contribute an additional $7,500 for catch up. With the 401k and the next, excuse me one moment. I'm so sorry. For the next couple that we're going to be talking about, the next couple types of retirement accounts that we're going to talk about, you can tell the company how aggressively you want to invest your money, and that can be very helpful. A lot of times, you know, when we're younger, and we learned about this in session 1, when we're younger, we're maybe more willing to take on more risk. So keep that in mind as you start to look at what type of retirement account and how you want that, how aggressively you want that money to be invested. The next type of retirement account I want to talk about is a 401(b). It's very similar, a 403(b) plan. It's very similar to a 401k, but it is for employees of nonprofits and public schools. Very similar as far as the earnings growing tax deferred. Some employers may offer matching, on the 403(b), they don't offer matching, but the same maximums apply, which are the 22,500 with an extra 7,500 if you are over 50. If they do offer matching on the 403(b)s, the employer match is not included in that maximum. For a 457(b), which is for state and local government employees, we often call them deferred compensation because the money grows tax deferred. The same contributions apply, and employers may match, but they very seldom do. But they do have that catch-up permitted. So make sure that you keep that in mind. But the reality is, if you're over 50 and you can do catch-up contributions, do that. With an IRA, it's an extra $1,500 a year that you can put in. With an employee-sponsored account, it is $6,500. So you don't want to pass up opportunities to be able to increase what you're saving.
Katrina, can I
Yes.
jump in with a question?
Sure.
I'm an independent contractor in commercial real estate.
Mm-hmm.
What are my options for putting away besides Roth?
So you can do some of those other for self-employed individuals, and we can talk about that at the end if you don't mind.
Okay, I might be.
You have to cut. Do you have to leave early?
Well, my battery might die, and I forgot my cord.
Okay. So some of these other, I'm just going to go back really quickly. As a self-employed person, you can do any of these employer-sponsored ones as well.
Okay.
Okay.
Thank you.
The SEP is probably a really good option for you. For small business owners, you can do up to 25% of your compensation. So that's a pretty sweet deal.
Okay. Thank you.
Okay, sure. So we don't want to miss out on the chance to pass up free money. So you always want to ask your employer if they offer matching. And the reason I say don't pass up free money is, let's look at it from the perspective of, okay, I'm working for this company and I have a 401k. If I deposit 5% of my salary into my 401k, my employer is going to match 3%. If I don't take advantage and put in the full 5% so that I miss out on the 3%, I'm basically giving away 3% of my salary that could go into my retirement. Never ever give away any matching contributions. Don't miss out on that. It's really important because that doesn't count against you with your that doesn't count against you on your maximums. But again, it's free money, and at the end, when you're coming up on retirement, that money can really add up to a significant amount of retirement income. So now let's switch gears. We've spent the last 15 minutes talking about retirement accounts, but now I want to talk about the good stuff, planning and thinking about building wealth building accounts. So a brokerage account allows you to deposit money that you plan to use to buy and sell stocks, bonds, mutual funds, exchange traded funds, whatever. These accounts are also sometimes called taxable investment accounts. But basically, the accounts that we've talked about up until now are for our retirement planning purposes. We're going to start that when we're young, as we grow older, eventually when we're 62, and we didn't even talk about this, and I should have mentioned it. Once you turn 72, the IRS mandates that you have required minimum distributions from your retirement accounts, and you have to start making sure that you take that money out when you need to. Now, I do know that there are some federal laws that are changing, and as we start to get older, because we are an aging population, they're changing those minimum distribution ages. I think it's transitioning from something like 72. Over the next few years, it will be 75. So make sure that you talk with your tax professional to make sure that you don't end up having to pay a penalty. Again, we're talking about those prior retirement accounts that we've just been talking about. The penalty for not withdrawing what you're required to pull is 50% of what you were supposed to pull out. So let's just say you were required to take $5,000 a year as a required minimum distribution from your retirement accounts, and you didn't, you forgot. The penalty for that would be $2,500. That's a lot of money to be penalized. So make sure that if you have those retirement accounts, that you talk with your tax professional and make sure that you're making those required minimum distributions. And we see advertisements and things like that. You see information about it. They often call them RMDs, and that again stands for required minimum distribution. And the IRS.gov has some really great resources available on that. So let's go ahead and switch those gears to wealth building accounts now. We're going to talk about 3 different types of accounts for wealth building accounts. And the first one is sort of this electronic trading platform where you're going to be buying and selling. You'll be doing that through what's called a broker or a broker dealer. And that's for those individuals who want to manage their own portfolio. You want to do the research, you want to do the homework, you want to, we were talking earlier before the session formally started, we were talking about how, if we had done the research and we bought certain types of stock, we could be, multimillionaires if we hadn't even done anything else throughout the life of those stocks. And that's absolutely true. So individuals who want to self-manage their own portfolio and do their homework, they will need somebody to be the intermediary to help you buy and sell. You can't just call up a company and say, well, I want to buy 10 of your stock. That's not a thing you can do. You also can't call up to You can't call to the New York Stock Exchange and say, hey, dude, I want to buy 5 stock in this company. You have to have a guy or a girl, a person who's going to be that intermediary and allow you, and they'll take your order. They're like an order taker. They're going to do what you tell them to do. The next type of account I want to talk about is a robo-advisor. Now, a robo-advisor is sort of for those of us who want to be hands-off kind of people. I want to put so much money a month into my wealth building account, but I don't want to think about it. I want to set it and I want to forget it. For those of us who want to be hands-off investors, we can answer a series of questions. This says it's a few. There's actually quite a few questions you can answer. But what's cool is they have a computer that will analyze your answers and help you to get into the right types of investment accounts, whether those are mutual funds, exchange traded funds, all the different funds we've talked about. The nice thing about that is those fees are going to be lower than what you're going to get with the broker and broker dealer. A broker and broker dealer is going to be paid by transaction. So if you're buying and selling all the time, you're going to be paying more for each transaction. You're going to be paying a percentage. With a robo-advisor, the fees are really low. So that's something that if you just want to be that person that knows in the back of your head, in the back of your mind, you've got your stuff going on, you've got this money that's coming in, you want to look at your quarterly statements or your monthly statements and see what's happening. You want to be kind of a set it and forget it and let it go. This might be the right way for you to go. Another type of account would be a full service brokerage account. Sort of like the traditional advisor that you see on TV. They're going to get to know you. They want to know what your goals are. They want to know that by the time you're 65, you want to have $2.4 million in the bank and you want to have no debt. They're going to help you with reaching those goals. They're going to help you with more than just your investing goals. They're going to help you make sure that you've got that debt paid off. They're going to make sure you are, you own the home free and clear. But you have to understand that with that more intense relationship, the fees that you're going to pay are going to be higher. So keep that in mind. And they may, with managed accounts, sometimes they charge a flat fee. Sometimes they charge an hourly fee. Sometimes they charge a fee based upon how much money you have that they're managing. That's called assets under management. So that's, there's a lot of different ways that you can end up paying for your investment professional, but that's okay because that's what that's about. But I want to talk now about some of the things that we need to consider before we open those investment accounts, because there's a lot more to it than just deciding to open an account and start investing. And we're going to dig deeper into how to do this in our next session. But I do want to make sure that we talk some about today. Before you open an investment account, you want to investigate the professional, investigate the firm, and take a look at some of the things that we should do. We want to make sure that the firm is licensed. We want to make sure that we understand the different types of investments that they offer. Remember, we talked about stocks, bonds, mutual funds, investment, or there's real estate investment funds, there's commodities, there's so many different types of investments out there. You want to make sure that whatever investments you're considering, you understand. And we'll talk more again about how to understand that, where to go to learn more when we meet next month. But you'll want to make sure that you review your client relationship summary. The client relationship summary is a document that every professional is required to provide to their clients, but they also can they can also be asked for it, and they are required to give it to you. What's cool about the client relationship summary is that it mandates in plain English, in a specific order, that the company disclose fees, actions that may have been taken against that professional. It's going to give you all the terms. It's going to tell you if there may be a conflict of interest that you should be aware of. It outlines everything in plain English. So that's a really important piece of paper. But you also want to go to check out BrokerCheck. And I know I mentioned BrokerCheck in our first session, but BrokerCheck is a great place to go where you can learn all about the investment professional and the firm that you're considering hiring to handle and manage your funds. So make sure that you investigate that professional before you invest. And again, that's brokercheck.finra.org. Now, one thing that we always want people to understand is that there can be a tax ramification for anything that you do, whether it's using your retirement accounts, your wealth building accounts. So talk to your tax professional before you start taking money from your accounts. Make sure that you're not going to end up making a big mistake by paying a lot of penalties. The penalties for early withdrawal of a retirement account can be up to 30%. And that can add up to pretty significant amounts of money. So you want to avoid using particularly your investment accounts. Wealth building accounts are sort of their own thing. Retirement accounts are specific for planning to retire. So making sure that you're not using your retirement accounts to fund emergencies, because you end up paying a huge penalty and you may not have time to earn that money back. So you want to avoid paying for emergencies with retirement accounts. And then if you are forced to, sometimes it's the only option. Just make sure that you understand the fees and penalties that you're going to be charged, and try to have them withheld before you get the actual payout. Now, we talked about risk tolerance and diversification in our first session, but you want to make sure that whether you're investing for wealth building, whether you're planning to invest for your retirement, don't put all your eggs in one basket. Please make sure that you think about your risk tolerance. If I am in my early 20s, I might be more willing to take on a higher risk so that I can get a higher return on my investment. But as I turn into my 50s, maybe my 60s, 70s, I don't want to take on a big risk for a retirement account if I'm starting to think about when I might retire. So make sure that you think about that risk tolerance when you're looking at different types of investments and how you want your money to go. So keep that in mind. You know, one of the things that I think is really, really important is providing resources and materials so that you can learn more, because the truth is I can talk for days and days about investing. I can talk for days and days about investment frauds and scams and all the things. But the reality is that you can learn so much more on your own by checking out the different options, resources that are available. So today I want to tell you about the Department of Banking and Securities. That's my office. We have publications and so many resources available on our resources page. I would encourage you to check that out. The Securities and Exchange Commission has a great page called investor.gov. They have resources where you can learn more about investing, protecting the assets, and different strategies. That's another option, another presentation that we can do at some point, is just talking about different types of investment strategies. The IRS, again, has some really great resources specifically for retirement plans. They have some information about leaving wealth to your loved ones and how to do that in a tax efficient manner. So those are all really great resources available for you as well. Now, if you have questions about a financial institution, a transaction, something that maybe a car dealership has done, or you bought a money order and there's a problem, did you know that the Pennsylvania Department of Banking and Securities regulates most of the finance industry? And you can actually call our office and speak to a consumer services specialist who would be happy to help you understand what's happening. They can provide you with different resources, and they can help you to submit a written complaint so that if there is a problem, we can help to resolve it for you. So you can call our office at 800 PA Banks, or you can fill out the form, the complaint form, on our website at dobs.pa.gov. Now, before I go to questions, I do want to go to the next slide so that we can stop the recording. We can go ahead and stop the recording. My name is Katrina Boyer. If you have questions, concerns, you can reach out to me after the fact. Be happy to answer those questions for you. And then if we want to stop the recording, I'll go ahead and take any other live questions that we may have.